as we mentioned, CVP relationships are linear, just like the costs are linear that we've been talking about linear examples. So when we're looking at this example here, if we have 0 units sold, we have an operating loss of 80,000 because we don't have anything to cover our fixed expenses. When we look at that in graph form, so we look at a CVP graph, this is where we have our sales, which are the green line, the total expenses, which are the blue line, and fixed expenses, which are the red line. So where our sales revenues crosses the line of total expenses, that is the break even in units. Anything below the break even in units, we operate at a loss. And anything above the break even in units, we have a profit or a positive profit. So this is an example of a CVP graph where we look at sales versus total expenses and fixed expenses. This is a profit graph where it just shows the profit line. So where, depending on the number of bicycles sold, we extend to create a profit. And we know that the break-even point is where the profit is 0 or at 400 units sold. If we increase our sales from 400 to 500, we increase our contribution margin by $20,000. So remember, our contribution margin per unit was $200. So $200 times 100 bikes is $20,000. Our contribution margin ratio is 40%. So if we increase our sales volume to 500 bikes, we would expect the profit or operating income to be $20,000. This is our profit before taxes. So we take our contribution margin ratio times sales minus fixed expenses. We're going to look at a couple examples of when we make changes in certain amounts and how that changes our results. So here we have our sales are increased by 20,000, but our net operating income decreases by 2,000. So what happened is we increased our advertising by $10,000. That increase in advertising of $10,000 increased our total fixed expenses. That increase in advertising resulted in 40 additional units of sales. But 40 additional units of sales, given our contribution margin of $200 per unit, was not enough to cover that additional fixed cost of advertising. So when we're looking at this analysis, we would decide if $10,000 increase in advertising only gives us 40 additional units, it doesn't do us any benefit to actually spend those advertising dollars. In fact, we decrease our net operating income, resulting in a lowered profit. So we could look at that using incremental analysis. So the incremental analysis is just what is different between the two choices. So rather than doing a full income statement of 540, we can just look at what's the increase in contribution margin from this additional sale of 40 units times our $200 contribution margin per unit, and what is our increase in fixed cost instead of looking at the total new fixed. So we see that we would have a resulting decrease in net operating income of $200,000. So we're going to go through several of these examples where we look at the different impacts that different changes in cost and sales would have. So in this example, we change our variable cost and the sales volume. So we have higher quality materials. Therefore, we increase our variable cost per unit by $10. So that increase in variable cost per unit by $10 is going to decrease our contribution margin that was $200. It will increase unit sales by 80. So we're going to increase our sales from 500 to 580. So when we look at the impact of that, we actually increase our operating income by $10,200. So we change our variable cost from $300 to $310, which changes our contribution margin from 200 to 190. Example 3, we change the fixed cost, the selling price, and sales volume. So we're doing a whole combination of things. So we decided not only are we going to increase our monthly advertising budget, we're also going to give a discount on our sales price. So if you remember from the first example, when we increased our monthly advertising budget, we didn't sell enough extra in order to cover what that additional fixed cost was. Now, if we do a fixed cost increase and a selling price decrease, which is also going to decrease our contribution margin, we actually increase sales by 150 units per month. So what does that do to our bottom line? We increase sales and fixed cost, and we have a net increase in our operating income of $2,000. So we would just have to decide, does $15,000 in additional fixed expenses, is it worth it to us for a net operating income increase by $2,000? What would be the big question there is, do we anticipate this increase in sales every month? So do we think we could always do an additional 150 units, or was that just a one-time thing as an effect of just lowering the sales price? Okay. Under number 4, we want to know, what if we pay a $15 sales commission to our salespeople? So right now we're paying them $6,000 per month. And instead we're going to change that from $6,000 per month to $15 per bike. So one of the things that does is change our fixed expenses, and we're shifting that fixed expense to a variable expense. So right now we have this $6,000 per month fixed cost, and now we're changing it to a variable cost based on bikes. So here we see that we have increased our sales and our fixed expenses decreased by $6,000. Therefore, we've increased our net operating income by $12,375. So if we have 575 units times that $15 sales commission, our sales team is actually getting paid more money than they are with just the straight fixed cost, and it's boosting our sales and ultimately boosting our net operating income, because our salespeople have this incentive to sell more bikes in an effort to increase their salary. In this example, we have an opportunity to sell 150 bikes to a wholesaler without disturbing sales to other customers or fixed expenses. So what price are we going to quote to the wholesaler if we want to increase our monthly profits by $3,000? So there we're going to look at, what is the variable cost per bike, and what is the amount that we want to generate from the sales. So we want to get an extra $3,000 from the sale of those 150 bikes, which means that we need $20 markup on those bikes to generate that extra income. We also need to cover at a minimum our variable selling or variable cost per bike. So the selling price per bike, in order to cover both our variable costs and give us an increase in net operating income of $3,000, that sales price needs to be a minimum of $320. In addition to the break-even amount, we can use that calculation to decide what do we need in order to hit a target profit. So how many things do we need to sell in order not to just break even, but what if we have a target profit of $10,000 or a target profit of $20,000? Then we know not only how many we need to sell to break even, but how many extra we need to sell in order to meet that target profit. So when we look at an example, if we have fixed costs of 80,000 and we want to earn a profit of 100,000, we add that target profit plus our fixed expenses and divide by our contribution margin per unit. So in an effort to do that, we would need to increase our unit sales to $900 a month. So this is looking at that same information using the equation method. So solving for what is the quantity to hit that target profit. So we put in 100,000 as our profit. We have unit contribution margin of 200, and we're solving for quantity then using algebra to get that 900 units. So we get the same exact answer as this method. We're just spending a little bit more time in the math to do it. We can also use our contribution margin ratio to determine how much we must generate in sales to hit that profit. So we can either do it in the equation like this, or we can use the other equation with our contribution margin ratio. That's on the next slide. So we have a 40% contribution margin ratio, which is calculated by the contribution margin divided by the sales price. So here we have our target profit of 100,000 plus fixed expenses divided by our contribution margin ratio, which gives us total dollar sales of 450,000. You can see using our contribution margin calculations save us time in doing the math. Margin of safety is the amount that sales can drop before we incur a loss. So what the margin of safety is the difference between a positive operating income and our break-even point of $0 in operating income. So this can help us calculate our operating income at any sales level. So we're going to look at an example of that. So if we assume we have actual sales of 250,000, our break-even sales is 200,000. So our margin of safety is 50,000. So that's not how that saying that we have 50,000 in net operating income. It's saying that we have 50,000 in sales dollars between a positive operating income and a negative operating income right now. So if our sales dollars drop by 50,000, then we're going to have 0 or dollars. So when we look at that, what that margin of safety is, we see that the 50,000 divided by our total sales of 250,000 results in 20%. So we know that our margin of safety is 20% of sales. So then when we're looking at calculating in units, so we can look at it in the number of units sold. So the margin of safety at 50%, and each bike sells for $500, so our margin of safety is 100 bikes. So we can look at it as the total number of bikes. We can also look at it as a percentage. When we use that 20%, then we can use that to calculate what our margin of safety is at different sales methods and how that affects our operating income.